Right now, millions of seniors are about to face a Social Security reality check they did not see coming. The 2026 COLA announcement is shaping up to be one of the most consequential adjustments in recent memory. What most people are not being told is how this single number will ripple through every part of your retirement income. If you depend on Social Security for even a portion of your monthly bills, you need to hear this today. I have spent over 30 years helping people just like you protect their retirement income. What I am seeing right now with the 2026 COLA projections genuinely concerns me. There is a specific financial trap built into the way this adjustment works that catches most retirees off guard. By the end of this video, you will know exactly how to sidestep it and keep more of your money. This is not just about a percentage number on a government website. This is about whether your grocery budget, your prescription costs, and your housing expenses actually get covered next year. I am going to walk you through the real numbers, the hidden pitfalls, and one benefit rule that almost nobody claims. Grab a pen and a notepad because you are going to want to write some of this down. Let me start with the basics so we are all on the same page. COLA stands for Cost of Living Adjustment, and it is the annual raise Social Security gives your monthly benefit. The Social Security Administration calculates COLA using the Consumer Price Index for Urban Wage Earners, known as CPIW. This measurement tracks how much prices change for things like food, energy, medical care, and housing. Every year, the SSA compares third-quarter CPIW data from the current year to the previous year. If prices went up, your benefit goes up by a corresponding percentage. If prices stayed flat or went down, your benefit stays the same with no decrease. According to SSA.gov, the 2025 COLA was 2.5%, which was already a significant drop from the 3.2% increase in 2024. Now here is where 2026 gets interesting and a little unsettling. Early projections from the Senior Citizens League and the Congressional Budget Office suggest the 2026 COLA could land between 2.0 and 2.6%. That range might sound reasonable until you realize what inflation is actually doing to your daily expenses. The things seniors spend the most money on, like healthcare and housing, are rising faster than the overall CPIW measures. Think of it this way. Imagine you get a 2% raise at work, but your rent goes up 3% and your medications jump 5%. You technically got a raise, but you are actually falling behind every single month. That is exactly the squeeze millions of retirees face when COLA does not keep pace with senior-specific inflation. The average Social Security retirement benefit as of early 2025 is approximately $1,976 per month, according to SSA.gov. A 2.0% COLA on that amount would add roughly $39.52 per month to your check. A 2.5% COLA would add about $49.40 per month. Those numbers might sound helpful, but wait until you see what is being taken out on the other side. Let me dig into the first major insight that most financial commentators are skipping over entirely. Your gross COLA increase is not the same as your net COLA increase. Before that extra money ever hits your bank account, Medicare Part B premiums are deducted directly from your Social Security check. For 2025, the standard Part B premium is $185 per month, and projections for 2026 suggest it could rise to between $190 and $197 per month. Let us run the numbers together so you can see the impact with your own eyes. If you currently receive the average benefit of $1,976 and you get a 2.3% COLA, that adds about $45.45 per month. But if your Part B premium rises from $194, that is an increase of $9 per month. Your actual net increase drops to roughly $36.45 per month, which is barely $1 a day. Now consider seniors who receive below-average benefits. About 40% of Social Security recipients get less than $1,500 per month. A 2.3% COLA on a $1,400 monthly benefit adds just $32.20. After a $9 Part B premium increase, you are left with $23.20 in additional monthly income. That $23.20 has to cover every price increase you face for the entire year. Gas prices, grocery bills, utility costs, and out-of-pocket medical expenses all eat into that tiny raise. It is no wonder that the Senior Citizens League found that Social Security benefits have lost approximately 36% of their buying power since 2000. Your check might be bigger on paper, but it buys less at the store. Here is something else that catches people by surprise every single year. The COLA percentage is applied to your base benefit amount before any deductions. So if you have Medicare premiums, tax withholding, or garnishments, your usable increase is always smaller than the headline number. Many seniors see the COLA announcement on the news and expect a certain dollar increase that never actually materializes in their bank account. Let me give you a concrete example using real numbers. Say you are a married couple and you both receive Social Security. Your combined monthly benefit is $3,400 before deductions. A 2.3% COLA would add about $78.20 to your combined gross benefits. But both of you pay Medicare Part B, so if premiums rise $9 each, that is $18 gone right away. Your combined net increase is now about $60.20 per month. Over a full year, that is $722.40 in additional income. Meanwhile, healthcare costs for a couple over 65 have been rising by an average of $1,200 to $1,800 per year, according to recent studies. You can see the math does not work in your favor without careful planning. This is not meant to scare you, but to prepare you. Understanding these numbers puts you in a position of power, not vulnerability. Knowledge is the single best tool you have to protect your retirement income. There is also a lesser-known factor called the hold harmless provision that affects how COLA interacts with Medicare premiums. Under this rule, your Social Security benefit cannot decrease from one year to the next due to a Part B premium increase. In practical terms, if the Part B increase would eat up more than your COLA raise, your premium increase is capped. However, this protection does not apply to everyone, and certain higher-income retirees are excluded. If you are subject to IRMAA, the income-related monthly adjustment amount, you pay higher Part B premiums based on your modified adjusted gross income. IRMAA thresholds are based on your tax return from 2 years prior. For 2026 premiums, the SSA will look at your 2024 tax return. A one-time income spike from a Roth conversion or asset sale in 2024 could push you into a higher IRMAA bracket right when COLA is modest. Stay with me, because what I am about to show you will surprise you. Most people think COLA is just a straightforward percentage bump that helps you keep up with inflation. But the way COLA interacts with taxes, Medicare premiums, and other benefit thresholds creates a complex web of financial consequences. Understanding these hidden dynamics can literally save you thousands of dollars over the course of your retirement. Let us talk about the second major insight that trips up retirees every single year. Up to 85% of your Social Security benefits can be subject to federal income tax. The income thresholds that determine whether your benefits are taxed have not been updated since 1993. As your COLA increases push your benefits higher, you may cross a tax threshold and actually owe more in taxes. Here is how the taxation of Social Security benefits works at the federal level. If you file as a single individual and your combined income exceeds $25,000, up to 50% of your benefits may be taxable. If your combined income exceeds $34,000 as a single filer, Up to 85% of your benefits could be taxed. For married couples filing jointly, those thresholds are $32,000 and $44,000 respectively. Combined income is calculated by adding your adjusted gross income, any non-taxable interest, and half of your Social Security benefits. A COLA increase raises the Social Security portion of that calculation. Even a modest 2.3% COLA increase could be enough to push you over one of these fixed thresholds. Once you cross that line, a chunk of your so-called raise goes straight to the IRS. Let me walk you through a real-world example to make this crystal clear. Imagine you are single with a monthly Social Security benefit of $2,100 before the 2026 COLA. You also have a small pension of $800 per month and some interest income of $150 per month. Your combined income sits right at about $33,550 per year, just below the $34,000 threshold for 85% taxation. Now your 2026 COLA kicks in at 2.3%, adding $48.30 per year to your Social Security. That pushes your combined income to approximately $33,840 per year. You are still just below the $34,000 threshold in this scenario, but one small change could push you over. An extra $160 in bank interest or a small required minimum distribution would tip you into the higher taxation bracket. Once you cross that $34,000 threshold as a single filer, the jump in taxes can be significant. You go from having 50% of your benefits potentially taxable to 85%. On a $25,200 annual Social Security benefit, the difference between 50 and 85% taxation could mean an extra $2,000 to $3,000 in federal taxes owed. That wipes out your entire COLA increase and then some. This is why I always tell people that COLA is not free money. It is a gross adjustment that gets filtered through multiple layers of deductions and taxes. Without understanding how those layers work, you cannot make smart decisions about your retirement income. The good news is that there are specific strategies to manage this, and I am going to share them with you today. One strategy that works for many retirees is managing the timing of income from retirement accounts. If you know your combined income is close to a tax threshold, you might choose to take distributions in a year when you have lower other income. Roth IRA distributions, for example, do not count toward your combined income for Social Security taxation purposes. Strategic Roth conversions done before you start collecting Social Security can reduce your tax burden for decades. Another approach is to review your withholding on Social Security payments themselves. You can request that the SSA withhold federal taxes from your monthly benefit at rates of 7, 10, 12, or 22%. Filing IRS Form W-4V allows you to set this up and avoid a surprise tax bill in April. Many retirees prefer this approach because it smooths out their cash flow throughout the year. You should also be aware that 13 states currently tax Social Security benefits to some degree. These states include Colorado, Connecticut, Kansas, Minnesota, Missouri, Montana, Nebraska, New Mexico, Rhode Island, Utah, Vermont, Virginia, and West Virginia. Each state has its own thresholds, exemptions, and rates that may differ from federal rules. If you live in one of these states, your effective COLA increase shrinks even further after state taxes. Now here is the part most seniors never hear about. There is a provision in Social Security law that can actually increase your benefit beyond the standard COLA if you meet certain criteria. It involves the recalculation of your primary insurance amount based on additional earnings. And most retirees who could benefit from this provision have no idea it even exists. Here is how this recalculation works and why it matters for your 2026 income. Social Security calculates your benefit using your highest 35 years of earnings. If you continue to work and earn income even while collecting Social Security, the SSA automatically reviews your earnings record each year. If a recent year of earnings is higher than one of the 35 years used in your original calculation, your benefit is recalculated upward. This recalculation happens automatically, but many retirees do not realize it and stop working prematurely. Even part-time work that generates modest income can replace a low-earning or zero-earning year from decades ago. For example, if you had several years of low income early in your career, even $15,000 in current earnings could boost your benefit. The increase might be $10 to $50 per month on top of your COLA adjustment. Let me give you a specific scenario to illustrate this. Say you worked part-time as a consultant in 2025 and earned $18,000. Back in 1985, you only earned $8,000 in inflation-adjusted terms during one of your 35 calculation years. The SSA would replace that $8,000 year with your $18,000 year in the benefit formula. This recalculation could add an extra $12 to $30 per month to your benefit starting in late 2026. That might not sound like a fortune, but it stacks on top of your COLA increase and compounds over time. Over a 10-year period, an extra $20 per month equals $2,400 in additional income. Combined with your annual COLA adjustments, this creates a meaningful boost to your total retirement income. The key is understanding that this recalculation is a separate process from COLA and provides an additional pathway to a higher benefit. Now I want to address another critical issue with the 2026 COLA that involves Medicare Part D prescription drug costs. The Inflation Reduction Act capped out-of-pocket prescription drug costs at $2,000 per year starting in 2025. While this is a significant benefit for many seniors, the premiums for Part D plans are still subject to change each year. For 2026, early estimates suggest Part D premiums could increase by $3 to $8 per month depending on your plan. If your Part D premium rises by $5 per month, that is another $60 per year taken from your COLA increase. Combined with Part B premium increases, you could see $15 to $20 per month deducted from your gross COLA raise. On a $40 per month gross COLA increase, losing $15 to $20 to premium hikes leaves you with $20 to $25 in actual spending money. This is why looking at COLA in isolation gives you a dangerously incomplete picture. I want to walk you through a comprehensive example that pulls all of these pieces together. Meet a hypothetical retiree named Margaret, who is 68 years old and lives in Missouri. Margaret receives $2,200 per month in Social Security and has a small IRA that generates about $400 per month in required minimum distributions. She is enrolled in Original Medicare with a Part D prescription drug plan. In 2025, Margaret's monthly Social Security is $2,200. And her Part B premium is $185 deducted from that amount. Her Part D premium is $42 per month, also deducted from her Social Security check. After premiums, Margaret receives $1,973 per month deposited into her bank account. Her annual Social Security after premium deductions is $23,676. Now let us apply a 2.3% COLA for 2026 to Margaret's situation. Her gross monthly benefit increases by $50.60 to $2,250.60 per month. If her Part B premium rises to $194, that is a $9 monthly increase. If her Part D premium rises to $46, that is another $4 monthly increase. Margaret's total premium deductions go from $227 to $240 per month, an increase of $13. Her net monthly deposit goes from $1,973 to $2,010.60, a real increase of just $37.60 per month. Over the full year, Margaret gains $451.20 in actual spending money. Meanwhile, her grocery costs alone have likely risen by $600 to $900 over the same period based on recent food inflation trends. But Margaret's situation gets even more complicated when we factor in taxes. Her combined income for Social Security taxation purposes includes half her Social Security plus her IRA distributions. Half of her $27,007 annual Social Security is $13,504, plus $4,800 in IRA income gives a combined income of $18,304. Since she is single, she is below the $25,000 threshold and currently pays no federal tax on her Social Security. However, Margaret lives in Missouri, which does tax Social Security benefits for some residents. Missouri has been phasing out its Social Security tax, and by 2026, it is expected to be fully eliminated. This is actually good news for Margaret and the roughly 120,000 Missouri retirees who were affected. Not every state is moving in this direction, so you need to check your own state's specific rules. Let us now compare Margaret's situation to a higher-income retiree to see how COLA impacts people differently. Consider Robert, a 72-year-old in Connecticut who receives $3,100 per month in Social Security. Robert also has pension income of $1,500 per month and investment income of about $800 per month. His combined income puts him well above the $34,000 threshold for 85% taxation. Robert's 2.3% COLA adds $71.30 per month to his gross Social Security benefit. After a projected Part B premium increase of $9 and a Part D increase of $5, his net increase is $57.30 per month. But because 85% of his benefits are taxable and he is in the 22% federal tax bracket, about $12.62 of that net increase goes to federal taxes. Robert also pays Connecticut state income tax on his Social Security, further reducing his actual gain. After all deductions and taxes, Robert's real monthly increase from the 2026 COLA is approximately $40 to $45 per month. On a $3,100 base benefit, that means Robert keeps roughly 56 to 63% of his gross COLA increase. Higher-income retirees consistently lose a larger share of their COLA to taxes and premium surcharges. This is the compounding effect that financial news rarely explains in full detail. There is another comparison worth making that involves spousal benefits and COLA. If you are receiving spousal benefits, your COLA is applied to your spousal benefit amount, not your spouse's benefit. For example, if your spousal benefit is $980 per month, a 2.3% COLA adds $22.54 per month. After premium increases, your net gain could be as little as $10 to $13 per month. Survivor benefits follow a similar pattern, but are typically higher than spousal benefits. If you are a widow or widower receiving $2,400 per month in survivor benefits, the 2.3% COLA would add $55.20. After premium deductions, your net increase would be approximately $42 to $46 per month. Every benefit type gets the same COLA percentage, but the dollar impact varies dramatically based on your benefit amount. Now I want to reveal the hidden gem that most seniors never hear about and almost never claim. There is a provision under Social Security that allows you to request a reconsideration of your benefit amount if you believe your earnings record contains errors. According to SSA.gov, approximately 3 to 4% of earnings records have some form of discrepancy. These errors can directly reduce your monthly benefit, and every COLA adjustment built on top of it. Think about what that means in practical terms for your 2026 benefit. If a single year of your earnings was reported incorrectly and your benefit is $30 per month lower than it should be, you have been losing $360 per year. Over 10 years of retirement, That is $3,600 in lost benefits, plus all the compounded COLA increases on that $30. Correcting a single earnings record error could add $40 to $60 per month to your current benefit when back adjusted. Here is how you check for errors on your earnings record right now. Go to ssa.gov and create or log into your My Social Security account. Click on your Social Security statement and review your earnings history year by year. Compare each year's listed earnings to your old W-2 forms or tax returns to verify accuracy. If you find a discrepancy, you can contact the SSA at 1-800-772-1213 to request a correction. You will need to provide supporting documentation such as W-2 forms, tax returns, or pay stubs from the year in question. The SSA will review your evidence and, if the error is confirmed, recalculate your benefit amount retroactively. This process typically takes 30 to 90 days, and you may receive back pay for the period the error existed. Another hidden opportunity that most seniors miss involves the Medicare savings programs. These state-administered programs can pay some or all of your Medicare premiums, deductibles, and co-payments. There are 4 levels of Medicare savings programs: QMB, SLIM, QI, and QDay. Each has different income and asset thresholds, and millions of eligible seniors never apply because they do not know these programs exist. For 2025, the Qualified Medicare Beneficiary Program covers your Part B premium if your monthly income is below approximately $1,275 for an individual. The Specified Low-Income Medicare Beneficiary Program helps if your income is below about $1,526 per month. These thresholds typically increase each year, and 2026 thresholds will be published by CMS.gov. If you qualify, having your Part B premium paid means your entire COLA increase stays in your pocket. Now let me give you your specific action steps so you can protect your benefits heading into 2026. These are things you can do today, this week, and over the next few months. Each step is designed to maximize the amount of your COLA increase that actually stays in your bank account. Do not put these off because some of them have deadlines that will pass before you know it. First, log into your My Social Security account at ssa.gov and verify your earnings record for accuracy. Review every year of your work history and compare it to your own records. If you find any discrepancies, call 1-800-772-1213 immediately to start the correction process. The sooner you act, the sooner any retroactive adjustments can be applied to your benefit. Second, check whether you qualify for a Medicare savings program by contacting your State Health Insurance Assistance Program, also known as SHIP. You can find your local SHIP office by calling 1-877-839-2675 or visiting shiphelp.org. If you qualify, enrollment can happen at any time during the year with no special enrollment period required. Third, review your Medicare Part D plan during open enrollment from October 15th to December 7th to ensure you have the lowest premium for your medications. Let me bring everything together so you walk away from this video with total clarity. The 2026 COLA will likely fall between 2.0 and 2.6% based on current inflation trends. That translates to roughly $39 to $51 per month for the average retiree before any deductions. After Medicare premiums, taxes, and other factors, your real increase could be as little as $15 to $35 per month. The single most important thing you can do right now is verify your earnings record and check your eligibility for cost-saving programs. These 2 steps alone could put hundreds or even thousands of extra dollars in your pocket each year. If you found this information helpful, I would appreciate it if you subscribed to this channel and shared this video with someone you care about. Next time, I will be covering a new Medicare rule change for 2026 that could save you up to $1,200 per year on prescription drugs. This channel is for educational purposes only and does not constitute financial or legal advice. Always verify directly with SSA.gov or Medicare.gov.